You've opened your TFSA, you have some money ready to invest, and now you're staring at thousands of stocks, ETFs, and funds, wondering, what do I actually buy? The investing industry wants this to feel complicated. Complicated means you hire someone, pay fees, and let them manage your money. But the truth is, the most effective investment portfolio for most Canadians is also one of the simplest ones in existence. Today, I'm going to show you exactly how to build it in about 30 minutes and with as little as $100. Let's start with the simplest possible option, because for most beginners, it's genuinely the best one. A single all-in-one ETF like XEQT or VEQT, which we covered in video 3 of this series, is a complete, globally diversified portfolio in one ticker. You buy one thing and you own over 9,000 companies across Canada, the United States, and international markets. XEQT and VEQT are 100% stocks, which means higher long-term growth potential, but more volatility along the way. In a bad year, they might drop 30 to 40%. In a good year, they might rise 20 to 30%. Over long periods, 10, 20, 30 years, the historical trend is strongly upward. If you're under 40 and investing for retirement, a 100% equity portfolio like XEQT or VEQT is entirely appropriate. Time is your protection against short-term volatility. If you want slightly less volatility, maybe you're closer to retirement, or you know a big market drop would cause you to panic and sell, XGRO or VGRO hold 80% stocks and 20% bonds, a bit smoother ride, slightly lower long-term returns. If you want slightly more control over your asset allocation and you're comfortable making 1 or 2 extra decisions, a 3 ETF portfolio is the next step up. Here's the classic Canadian version. VCN or XIC for Canadian stocks, about 20 to 25% of your portfolio. Canada is only about 3% of the global stock market, but holding some Canadian exposure reduces currency risk and gives you access to the dividend tax credit on Canadian stocks held outside registered accounts. XUS or VFV for US stocks, about 45 to 50%. The US market makes up roughly half the global economy and has historically been the strongest performing major market. XEF or VIU for international stocks, about 25 to 30%. This covers Europe, Japan, Australia, and other developed markets outside North America. You rebalance once a year, meaning if one part of your portfolio grows faster than the others, you buy more of the lagging ones to bring everything back to your target percentages. That's it. One annual review, 30 minutes, done. For most people, the one ETF approach with XEQT is honestly simpler and produces nearly identical results. The 3 ETF portfolio is for people who enjoy having a bit more hands-on involvement. Once you know what to buy, the next question is where to hold it, and this is where Canadians can meaningfully improve their after-tax returns. TFSA first, always. Hold your growth ETFs, XEQT, VEQT, or your equity portion in your TFSA. All dividends and capital gains are completely tax-free. This is the highest priority. FHSA second if you're saving for a first home. Same logic. Tax-free growth and tax-free withdrawal for a qualifying home purchase. RRSP third for higher earners. Once your TFSA is maxed, shift contributions to your RRSP. Hold the same ETFs here. You get the upfront tax deduction and tax-deferred growth. Non-registered account last. If you've maxed everything else and still have money to invest, good problem to have, a non-registered brokerage account works fine. You'll pay tax on dividends and capital gains here, but Canadian dividend-paying stocks get preferential tax treatment, so consider holding those here rather than in registered accounts. For most people starting out, you won't need to think beyond your TFSA for several years. Here's your action plan from today's video. Step 1. Open Wealthsimple if you haven't already. Step 2. Open a TFSA inside the app. Step 3. Transfer in whatever you can, even $100 to start. Step 4. Buy XEQT or VEQT. Step 5. Set up automatic monthly deposits and don't touch it. That's a complete investment portfolio. It will outperform the majority of actively managed mutual funds in Canada over a 20-year period, not because it's clever, because it's simple, cheap, and consistent. If you've been following this series from the beginning, you now have a complete picture of how to manage your money as a Canadian: accounts, taxes, savings rates, ETFs, real estate, and portfolio construction. That's more than most people learn in a lifetime. Next week, we're going deeper. I'll be covering the biggest money mistakes Canadians make in their 20s and 30s and exactly how to avoid them. Subscribe so you don't miss it. See you then.